This is your Wall Street wake-up call. Global stocks are steady as investors await Friday's jobs report, the final reading on the labor market before the Federal Reserve's all-important March meeting. For more, let's go to Brenda Kelly, the head analyst at London Capital Group. And Brenda, how would you characterize the markets right now? We've got the S&P 500, a little less than 1% away from 2,000.
Well, certainly I think we have seen something of a relief rally over the last number of days, and much of that I think has been down to the fact that many are not speculating that we'll see a rate hike from the Federal Reserve in the very near term. I think owing to the fact that we saw a better than expected GDP growth in the final quarter of the year is one thing, but it was ultimately down to an inventory build-up. So I think the first quarter of this year could actually see a slower number in terms of growth there. Ultimately, I think the labour picture is fairly stellar in the US, but I think global conditions might very well prevent the Federal Reserve from doing anything too soon in order to prevent any sort of upheaval or volatility in the markets that we've become so habitualized to.
So how important is Friday's jobs report for the Federal Reserve?
I think it'll still play a part in what the Federal Reserve's decision will be, but ultimately I think wage growth and I suppose expectations of consumer spending, which makes up 2/3 of the actual economy, will very much be front and centre for Janet Yellen when she makes her decision. Already the markets are not pricing in any hike in March. It's around a 10% chance, but I think looking towards the latter part of the year, perhaps September, I think markets are definitely building a consensus about maybe a 0.25% increase at that particular point. I think if you look down to what Janet Yellen said in January, the word uncertainty came up over 30 times, and I think that will be ultimately dictating where we go from here. The labour market is one thing, but inflation and wage growth will be a separate thing altogether, and I don't think they're where they need to be in order to facilitate a hike in the very near term.
All right, and we saw a pretty healthy increase in inflation last week, the Fed's inflation gauge, core PCE. But it's not just the Fed we're watching, it's also the European Central Bank. We have a meeting next week where Mario Draghi is expected to add more stimulus. Is that what you're expecting as well?
Well, I think he has very much flagged that we'll be seeing some stimulus from him, but ultimately it will more than likely be at the expense of banks. What has to be borne in mind is that the negative deposit interest rate is not going to be a positive for bank profitability. And while Mario Draghi has stated that that's not necessarily his problem, he doesn't really want to see a weak banking sector in what is already a somewhat weak economy within the Eurozone. Nevertheless, he is starting to run out of ideas and ultimately running out of assets to purchase, eligible assets that is. And I think if you look at where the euro is at the moment, I think markets are maybe preparing themselves to be maybe a little bit disappointed, as they have been wont to do over the last number of months. But certainly he has promised to do something, and I think we could see additional quantitative easing and perhaps an additional cut to the deposit rate. But I don't think it'll be everything that the market might have been expecting, and it may very well fail to underpin risk assets at this time.
All right, Brenda Kelly, the head analyst at London Capital Group. Brenda, thanks very much for joining us.
Thank you.
I'm Scott Gamm, and you're watching The Street.